Hey everyone, and welcome back to our masterclass series on retirement. This is going to be episode 2, talking about risk management. If you missed episode 1, you'll find a link in the description of this video to the entire masterclass series where you can go back and check out exactly what you missed and then come back here and rejoin us for part 2. In that part 1 video, we discussed time horizons and how they help you know when you'll need your money and how it all impacts your retirement planning and your investing as a whole. With that out of the way, let's hop into today's video, where we're going to get into something that sounds a little simple on the surface, but it actually runs a lot deeper when you really start to understand it. That's going to be risk tolerance. Now, when most people hear the term risk tolerance, they think it's about being either aggressive or conservative or some other word that they've heard to describe it before. But in real life, especially in private wealth, risk tolerance is layered, it's dynamic, and it's often misunderstood. So let's go ahead and I will take the next few minutes to walk you through what risk tolerance actually means, why it matters, and how to figure out where you stand. Let's start with a question. Have you ever made an investment decision based on fear or concern? Maybe you sold during a dip, or you stayed on the sidelines during a big rally, or maybe you chased returns after a friend's stock doubled. That's not uncommon, but it usually means your actual behavior didn't match your real risk tolerance. So before we go any further, we need to take that question and use it to clarify a few definitions around the word risk. Those would be risk tolerance, risk capacity, and risk perception. Risk tolerance is your willingness to take risk, while your risk capacity is your ability to take that risk. And then your risk perception is how you see said risk. It's important to have all three of these aspects of risk when you try to get yourself a complete picture. Most DIY investors typically only focus on one aspect, and it usually revolves around how they feel, and that can typically lead to the wrong investment strategy. So let's go ahead and break down risk into some categories. These are going to be the broad strokes that you've probably heard before, but they definitely will help us frame the discussion. The first level of risk tolerance will be conservative. A conservative risk tolerance will value stability. It will be held by somebody who would rather have modest returns instead of those big ups and downs. But there is a trade-off. Over time, it may lag inflation or fall short of long-term goals if you're too conservative. The next is moderate, or oftentimes called balanced. With this risk tolerance, you want growth and have a growth mindset, but you also want to sleep at night. This means you're going to be okay with some market fluctuation, but as long as it's not too extreme. The third risk tolerance is aggressive. This usually means you understand market moves and that you're willing to accept big swings if it means a better long-term return. But even aggressive investors can break down if they don't have the right framework or the right plan due to overaggression. This all seems pretty simple, right? Well, here's the catch. You may think you know your risk tolerance, but are you sure? You could very well think you're a conservative investor until you see your portfolio underperform the goals for the year. Or you might think you're aggressive until you see a 20% loss in one day and can't sleep a wink. That's why we have to go deeper when talking about risk tolerance. So naturally, the next question to ask is, how exactly do you figure out your true risk tolerance? Well, there's a few ways. Risk questionnaires can be helpful, but they don't tell you everything. The way a question is worded, something about an absolute dollar versus percentages, can totally change your answer, even if you don't realize it. So instead, here's a more human way to think about it. Ask yourself, what's your first instinct when markets drop? What's a financial loss you remember, and how did it affect you? Have you ever sold something at a loss and regretted it, or did you feel relief from that? Are your investment choices influenced by media, friends, or past experiences? All of these factors can greatly impact your risk tolerance and how you view it. Here at Confluent, we've worked with people who built their wealth through hard work and through saving, and these people are often more conservative. We've also helped entrepreneurs who took big risks in business and are more comfortable with high volatility in their portfolios. It's not about what's right, it's about what's right for you. This all brings us to the point in this episode where we bring it all together. Your risk tolerance isn't just one number, it should match each of your financial goals. That's because risk tolerance is goal-based, not just portfolio-based. Let's give a quick example. Let's say you're currently 45 years old with two major goals. Number one, you want to retire at age 62. Number two, you want to help your daughter with college in 5 years. For the retirement goal, you've got some time. You can afford to take risks and grow that portfolio. But for college, you definitely do not have time to ride out a 30% market drop and then recover. That portion needs to be stable. You're the same person with two different risk profiles. This is where individual investors often make mistakes. They will try to lump everything into one strategy instead of approaching each with the risk tolerance they deserve. So if you followed episode 1 with us and have made it this far in episode 2, you're probably asking, what does time horizon have to do with this? And it's simple. The longer your time horizon, the more risk your portfolio can take and likely should take, because you have time to recover from drawdowns and time to benefit from long-term growth. Let's put some numbers to it. Imagine 3 different portfolios. Portfolio A has an 8% return and 20% volatility, while Portfolio B has a 9% return and 25% volatility. Then Portfolio C is going to have a 10% return and 30% volatility. If you have a 2-year goal, Portfolio C is way too risky. It could wreck your plan. But if you're close to 25 years away, that risk might be the best path to success for you. Time gives you resilience, but you have to use it wisely. Here's the bottom line. You can only build a meaningful, lasting investment strategy if you understand your true risk tolerance. Not just how you feel today, but how you behave under pressure, what your goals demand, and what your timeline allows. At Confluent, we help our clients do exactly that. We connect their goals, values, and timeframes to a portfolio that makes sense for them and not just for the markets. You may be doing this for yourself right now, and you should. That's how you learn. But at some point, as the decisions grow and they become more complex, the stakes will get higher, and you'll want a partner who can ask you the right questions, that can challenge your assumptions, and help you build a plan that goes beyond what a risk score can capture. So that will bring us to the end of episode 2 here in our Retirement Masterclass. In episode 1, we discussed time horizons and how they impact your investments. And here we talked all about risk tolerance. Coming up next in part 3, we will discuss everything you need to know about evaluating your current situation when planning and investing for your retirement. So stay tuned and help yourself stay ahead. We hope you guys enjoyed this video on risk tolerance and how it plays into your plans for retirement. This video is actually part of a bigger series where we cover retirement from front to back and everything you need to know to build a strong strategy. So go ahead, give a thumbs up on the video, subscribe to our channel, hit that notification bell so you never miss an upload from us, whether it's a part of this masterclass or any other of the great material we're putting out to help you level up your investment game.